Hello, I'm Andrea Carpenter, and I'm a financial advisor here with Prosperity Partners Wealth Management. And as we head into the last quarter of the year, we're reaching out to share our thoughts and perspectives on the market and economic events that have brought volatility so far this year. It's easy to listen to the news of the day and feel pessimistic about the future, but short-term events should not drive long-term decisions. In 1970, in September, historically, it's been the worst month for the S&P 500, according to data from the St. Louis Federal Reserve. And this past September, that held true. The major indices reflected monthly changes ranging from negative 4.3% to negative 11.9%. The widely followed Dow saw a decrease of 8.8% for the month, and the S&P, which is a much broader index, saw a drop of about 10.5%, and we even saw bonds drop 4.3% last month. So what things did work against the market last month? And the factors causing the volatility have been the same headwinds of economic uncertainty that we've seen thus far in 2022. We saw the Federal Reserve increase interest rates by another 75 basis points. That, coupled along with the other raises that have happened this year, and rising inflation and continued supply chain issues, global unrest, and a growing talk of recession were all major contributors to that. The Federal Reserve Chair, Chief Jerome Powell, has made it clear in his remarks that this rising rate environment will continue until we see inflation begin to abate and return to its target of 2%. After years of historically low interest rates along with price pressures increasing, these adjustments have been a jolt to both the stock and the bond markets. And often stock and bond markets have an inverse relationship, meaning that they typically both don't go up or down together. This year, that's not been the case. And in fact, the U.S. Bond index was down a little over 14% through the first 3 quarters of this year. Now, in past cycles where the Fed has increased interest rates to stave off inflation pressures, such as in 1983 to 84 and 1994, just as an example, we did see the rate of inflation that is slow, and we didn't see an ensuing recession. In both of those cases, economic growth moderated, rate hikes ceased, and stocks posted very strong returns the following years in 1985 and 1995. Mark Twain once said, "History doesn't repeat, but it often rhymes." And in 1957, or since 1957 rather, there have been 13 periods when the S&P has lost 20% or more over a 6-month time period. 6 of the 7 worst of those centered around the 2008 financial crisis. And it's important to know that today's market weakness shares very little in common with the conditions we saw in 2007 and 2008, when a housing bubble fueled by weak lending standards and a lot of speculation caused the financial system stress. We have seen housing prices begin to rise, but bank capital standards are much stronger. Lending standards are much tighter. And not to mention that now what we see is not too many homes, but rather too few homes in various parts of the country, driving up demand and prices as well. So how might an investor react amid today's uncertainty? Well, we encourage you to look past the headlines. And, reacting to changes over a month or two can cause investors to either take on too much risk when the market's surging or panic sell when markets begin to decline. Staying focused on your long-term goals and your objectives help remove that emotional decision making. And we've always cautioned against trying to time the market. To be successful at it means that you have to consistently pick the market top and bottom in various market cycles. And we have yet to find anyone who's mastered that investment strategy. Maintaining a diversified portfolio based on your goals, your risks, your objectives is still the most effective path to reaching your goals. Now, regardless of market conditions, we know that your financial situation is unique, and our team has managed and seen many market cycles and various market conditions. And our focus is on your long-term financial success. Remember, volatility is temporary, but our commitment to you is unwavering. If you have any questions or concerns, remember we're just a phone call away. Please reach out, give us a call. And from all of us here at Prosperity Partners, it's an honor and privilege to serve as your financial advisors. We hope this information has been timely and helpful. Thank you.